Welcome to another installment of our Meet the Manager interview series. Today I'm joined by David Leduc, who is the portfolio manager of the Dreyfus International Bond Fund. David is also the Chief Investment Officer of Standish Mellon Asset Management. David, thank you for joining us today.
Thanks for having me.
Tell us more about the strategy of your fund and what sets your process apart from your peers.
Yeah, the fund seeks to generate total return through capital appreciation and income, and we do that by investing in a wide variety of fixed income markets, including developed markets and emerging markets. So the fund has wide latitude to invest in corporate bonds, high yield bonds, emerging market debt as appropriate, and we use currencies as well to generate total return.
Terrific. Now, would you say your process is more top-down or bottom-up?
Yeah, our process actually has elements both top-down and bottom-up, and I think our philosophy is we believe you really need to have both elements to both uncover all the opportunities in the market and manage risks across a lot of different cycles. So the top-down part of what we do looks at the global macro environment, we look at growth and inflation around the world, and we're really trying to determine what type of investments in the fixed income markets are most appropriate given the macro environment. The bottom-up part of the process is also extremely important, and that's where the security selection happens. So we have teams of expert analysts that are looking around the globe across all markets to identify specific investments in either companies or countries or currencies, and that populates the portfolio according to our investment view.
Great. Now, if you were thinking about the type of investor that would invest in this fund, what would be the type that this is best suited for?
Yeah, as we look at U.S. fixed income asset allocations broadly, we still perceive that investors have a lot of their assets in U.S.-oriented fixed income funds. And our view is that for those investors looking to get exposure to a much broader opportunity set of investments, for those investors that may be concerned about the low level of rates in the U.S., that may be concerned about the potential for inflation in the U.S. given central bank policy, I think it makes sense, in our opinion, to have exposure to a much broader array of investment opportunities across the globe.
Tell me, David, given that this is an international mandate, what role does currency management play in the fund?
Currency management is actually very, very important. The benchmark for the fund is an unhedged non-U.S. global bond benchmark, and so the markets that we're investing in have currency exposure. So the aim of the process is to make sure that we don't take any unintended bets in currency markets. So where the fund deviates in its currency exposure, those are in markets where we perceive that there's total return opportunity, either because of valuation, mispricing, or fundamental characteristics, or both. The fund, one thing that's important is the fund does have broad latitude to hedge that currency exposure back into the U.S. dollar, and we've done that at many points. So in the most recent market experience is a good example of that. So when we're in environments where the dollar looks like it'll be particularly strong, we do have the ability to hedge that currency exposure back into the dollar and therefore protect investors' exposure to currency fluctuation.
Great. Looking out over the next year, what's your view on volatility?
There are a lot of macro developments right now that we think will continue to cause moments of volatility in the markets. If you look at Europe right now, the political developments and also the economic environment would suggest that we will continue to have bouts of volatility. We saw this most recently with the Italian elections, and very recently with the situation in Cyprus. And so as we look across Europe and we look at the economic challenges there, the divergence of growth between the peripheral economies and the core of Europe, we would expect to see more things, more moments that create volatility. Of course, one of the big changes, I think, over the last several years is that there has been increasing central bank intervention, right? And we saw this most recently with Japan. So, so that activity has helped mute a little bit of the volatility, and we have seen that even with these most recent moments, right? A lot of the contagion effect in other risky assets was very limited this time, and I think part of that is because of the central bank activity and the backstops that have been put in place. But I think for us, we look at these markets and we look at the potential moments of volatility really as opportunities, right? And as we look at even peripheral Europe right now, we're finding opportunities even in specific securities in some of these markets that are very, very attractively priced, that have very, very strong credit quality characteristics. So, so we would expect more volatility over the next several years, but we're really not afraid of that. We see that as an opportunity for active management in the fund.
Okay. Would you like to elaborate a little bit more on the areas of opportunity that you're seeing?
Yeah, sure. I think that one of the observations that we've made and one of the experiences I think for fixed income investors over the last several years is that risky asset risk premiums have come down quite a lot. We've had very strong performance in high yield, in emerging market debt, in U.S. corporate bonds, even global corporate bonds. And so I think that in this fund, both asset allocation among sectors and security selection within them have both played very, very important parts in generating return through a lot of different market cycles. And I think the size of the fund is also very, very important because it allows us to make those asset allocation shifts. It also allows those individual ideas to really show up and influence return. And I think that that's one of the things as we look at the environment going forward, that security selection aspect, the stock picking aspect of what we do as managers is going to become more and more important because as risk premiums across broad market sectors have come down, the beta plays across different fixed income sectors may become less important drivers of return as opposed to the individual security specific type ideas. And I think again with some of the volatility that we talked about, more and more opportunities will be created for that type of security selection alpha in the fund going forward.
I agree. Well, some great insights, and I thank you for your time today, David.
Great, thank you.
And thank you for joining us.